Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but to teach you how everything works here. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. After an agonizing period where Wall Street decided it was done with one of the greatest growth stories in history, artificial intelligence and everything attached to it, today we got a reprieve. Maybe even a second wind that showered money on the cohort. For those of us with positions that rely on the AI data center build-out, like my charitable trust, do you know that this was one of the best days of the year? Although that wasn't fully reflected in the averages. The Dow advancing only 183 points, S&P gaining 0.88%, but the Nasdaq did jump 1.31%. I gotta say, today was a real relief because owning the AI stocks has been a very rough ride lately. First, we now realize that there may be not enough money to go around to keep the data center build-out going. Lately, we've found real obstacles to building these. Everything from a shortage of workers, lack of materials, not enough power, to the fact that the stock market's now punishing the hyperscalers for their ambitious expansion plans that were once lauded on Wall Street. These companies keep spending fortunes to keep up with each other, and Wall Street can't take it anymore. At the same time, the AI theme lost its luster, didn't it? Buyers moved on to other, more exciting areas. The consumer's resurgence out of nowhere, that's an exciting story, for example. It's ignited retail, anything connected to discretionary spending. And that's what drove, say, the stock of Carnival Cruise almost 10 points higher today on greater numbers that it released just this morning. And also, by the way, they reinstated the dividend. I've always been partial to cruise lines because they're so inexpensive, and Carnival Corp offers a real bargain. That's one of the reasons why the stock is exciting to people. Meanwhile, there are plenty of IPOs and acquisitions which have caused furious buying of the bank stocks. We saw a very positive article about Wells Fargo in the Journal. Goldman Sachs up 56% for the year, now eclipsed most of the performance of the Magnificent Seven. There's a reason for that. Goldman Sachs may be growing faster than almost all the stocks in tech, let alone the Magnificent Seven. And by the way, at a lot less risk, which is what really matters. These financial and consumer spending companies just keep delivering better and better and better expected numbers as expectations are incredibly low versus the monstrously high expectations for anything related to the data center. High expectations can be a real killer of tech stocks, and expectations are staying way too high. Now, the good news. The good news is that the year of magical investing has ended, so almost every one of the speculative stocks, meaning the quantum computing, the nuclear stocks, the undercapitalized data center builders, the bogus Bitcoin extensions, and alternative power companies, they've all gone out of style, thank heavens. I find those groups nauseating because so many of you were losing money. I was doing my best to try to get you out of them, but I didn't. What really mattered today, though, is the possibility that funding for the data center build-out, something that was beginning to seem chimerical, has tantalizingly returned to a degree of certainty. The possibility that there are many pools of capital that may still want to get into data center, into AI, could drive a whole host of down-and-out tech stocks higher. Rather than limping into 2026, these stocks have erupted.
House of pleasure.
It's very unexpected. But can it last? This is the question. Look, I've been a hypercritical person when it comes to the data center promoters of late. Their big dreams have started to sound more like nightmares. I've questioned the way that some of these companies sound so certain when certainty seems to be in very short supply. I don't like deals like the companies are doing where one company gives another company money and the recipient then buys product from the donor company. These are called lazy Susan deals or circular deals. They often hide the real weakness that's going underneath. You don't discover that until it's too late and you lose a lot of money. And I'm trying to protect you. My confidence, perhaps as well as yours, has been sorely tested by the news flow, which has been very negative. So let's do this. Let's talk about what needs to happen. What could go right? A little more optimistic to get the data center theme back on track. Right now, the biggest ambush in this market comes from Oracle, the debt-laden software company turned data center builder. They've got a huge client called OpenAI, the privately held company that's been a pioneer in artificial intelligence and the bots that go with it. You know it as ChatGPT. Oracle's charged with building out $300 billion worth of orders for these guys. What a great story. An old-fashioned tech company reinvents itself as a data center builder and crows about it. Not only does Oracle have the huge order from OpenAI, they got another $223 billion in orders from other companies. Oracle has put the potential revenue into something called RPO, or remaining performance obligation. Most of the time, that's almost as good as money in the bank. The OpenAI order, the revelation, initially sent Oracle stock from 241 to 345 and change in a single September trading session, although it closed that day at 328. Many other stocks in the data center complex took off, too, in sympathy. Of course, Oracle had to raise the money first, so they hit up the bond market for $18 billion, and that's when the problem started. Bonds can be insured with what's known as credit default swaps, which you can actually use to bet against those bonds, too, even if you don't own them. If you fear that Oracle might default, you buy the credit default swaps. The value of Oracle's credit default swaps soar when the value of the bonds goes down, or the perceived value. This spike was picked up by the media, and it derailed everything. Suddenly, Oracle's grand plan seemed impossible to pull off. And we now believe that the whole data center complex may be stalled. Oracle stock went into free fall, going from 328 down to 178, where it landed 2 years ago, until it went up a little bit today. At the same time, OpenAI, which is counting on the build-out to stay ahead of all comers, chose not to address the situation except by leaking to the media that it could still raise an endless amount of money because so many funds want a piece of the business ahead of the potential IPO. Oh, and they also mentioned a possible government backstop, which was incredibly discouraging, although they later walked that back. This week, we heard from the leaks that OpenAI could be raising as much as $100 billion at a valuation of more than $500 billion, maybe $657, ultimately $830 billion. Then but there was a weird stair step. They said it was going to be $750 billion just a couple days ago, and then it was just then it was $830 billion yesterday. I mean, that's terrific if it has veracity. And the reason I question is that every day it kind of went up a little, but nothing really happened at the company. Which brings me to what needs to happen now. First, OpenAI should strike while the iron's hot and try to raise $200 billion at a $1 trillion valuation. That trajectory that we got this week would seem to allow that. To me, that seems like the only way forward for them. With that fundraising, they can pay Oracle the money it needs now to build out these data centers. At that point, every other hyperscaler will have to keep spending on infrastructure to keep up with them. That's how we get to where all these data center stocks, from Vertiv and Caterpillar to CoreWeave and Broadcom, can reignite. Now, a lot of those stocks were up big today. And that's how we stay on top in the most important race in the world. Could it happen? You know what? At first, I thought it was pie in the sky, $1 trillion, $200 billion. But you know what? Maybe it is a possibility. People are still very excited about this group. Even if OpenAI raises, say, $100 billion now in a private round, and then comes back for a public round for another $100 billion next year, the data center theme could continue to hum. Of course, if OpenAI can't raise enough money, then we just reverse everything we saw today and we go back down. That's the way it works. I'm optimistic that OpenAI can raise the money, even as I don't like the way they're doing it with these leaks and the forced March valuation. I do think that they can pull it off. OpenAI does have monster hubris, though. It has no idea how to tell its story. It's way too self-assured. Management has zero humility. This could be a humbling moment, or it could demonstrate that they're right to be arrogant. I'm not sure which one it is. But the bottom line, no matter what, OpenAI needs to raise a lot of money, and it needs to raise it now, or else the whole data center edifice will go down and stay down. But if they raise $100 billion in the next couple of weeks, then we will live to play again, and we'll see plenty more days just like today.
That was easy.
Let's go to Patsy in Texas, please. Patsy.
Oh, Mr. Cramer.
Yes.
I want your opinion on Dell. Ever since I bought it, it started to slide, and it keeps going down.
All right, you're right to worry, because a lot of people are concerned that their parts themselves have gone up a lot, and their raw costs are going down. I think Dell can fall from here. I think it can fall, but not below much, maybe 115. 110, and you should buy it because Michael Dell be in there buying it with you, and he is a very smart fella, and he's not going to let those component costs bother the bottom line too much. And the stock is still up for the year. Let's go to Mary in Idaho. Mary.
Good afternoon, Jim. It's been a minute since last time I talked to you.
Okay.
And I want to congratulate you on your 20 years with Mad Money, the publication of your book, which I downloaded an audio copy of about 10 days ago.
Oh, great.
As well as all you do with the Investing Club. I really believe that you would, any investor would benefit from any or all of those items.
Oh,
so,
thank you.
Congratulations.
Thank you, Mary. I mean, I got a long week. I have not had a weekend where I haven't had to work in a long time. And I really appreciate your comments. It makes me feel like it's okay. It's all worth it.
It is worth it, but you do pay a price for it.
Yes, I do. Thank you, though. Thank you very much.
You're welcome. The stock I'm calling about has been in my portfolio, which is very small, for a while.
Okay.
And it's a company I do a lot of business with. They have a wonderful, large, quality product line. Their prices are in line with others in the industry. I've looked at their balance sheet. I've listened to their earnings calls, although I did miss this last one. And their customer service is absolutely incredible.
And which company is this, Mary? Which company is it? Which one?
It is Chewy.
Oh, okay. So Sumit Singh was on the show recently, and I got to tell you, I totally agree with you. But we are fighting a trend. People feel that Amazon can't be beaten, and I think that's wrong. Chewy's got a lot of ancillary businesses that will really help them. I'm with you. I'm a buyer of Chewy. All right, this could be a humbling moment for OpenAI, or maybe they pull it off. I don't know. I just wish they'd just stop being... I wish they had less viewers. How about that? And let's leave it at that. That's not a mean way to put it. Okay, anyway, Mad Money tonight. The government shutdown caused all sorts of data to be delayed, so I'm going straight to the source with Paychex to get a sense of the employment situation in our country. Then we are wrapping up our homework assignment for the year by taking a closer look at biotech company Kura. And we're playing America's favorite game, Am I Diversified, where I survey your portfolio to see if it passes the test, and we're using the new rules that I put together for you and how to make money in any market. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
If you want to get a real read on employment, I always like to check in with Paychex. That's the payroll processor and outsourced human resources play, mainly serves small and medium-sized businesses. This morning, Paychex reported a modest top and bottom line beat, management raising the midpoint of the full-year earnings forecast for the second quarter in a row. So far, so good. But when some of these analysts dug down, they saw things they didn't like. The company's management solutions business narrowly missed its revenue estimates. They said the full-year revenue outlook could come in closer to the low end of their previous forecast. I wouldn't be sure about that. But that is why the stock got hit today. Although, then again, Paychex tends to sell off on earnings even when the quarter's pristine. So let's dig deeper with John Gibson. He's the president and CEO of Paychex. To learn more, Mr. Gibson, welcome back to Mad Money.
Jim, happy Hanukkah and holidays to you and all your viewers.
Well,
great to be with you.
Thank you, and right back at you. Now, I know I read through all the analyst commentary, and all I could think of was that you had 18% revenue growth, earnings per share up 11%, generated a huge amount of free cash flow, and 38% increase year to date. And it was an extraordinarily good quarter. Maybe I'm reading a different quarter from some of these negativists.
Well, Jim, as you said, this happens a lot, and I got to tell you, I'm only halfway through your book, so I'm not sure I can even explain it. I'm a slow reader.
Thank you.
But to your point, we had a strong first half in the fiscal year. We delivered solid earnings, 18% revenue growth. We continue to demonstrate we're the best operators in the industry with the operating income. We actually raised earnings per share guidance again. This is the second time this year because we continue to get more confidence in the execution of our strategic plan. So client and revenue retention remains solid. As I said, our full service HR outsourcing business, our PO business, continues to perform exceptionally well. And quite frankly, we've just never been better positioned, I think, to capitalize on the market opportunities to both drive growth, I think continue to expand margins, and really strengthen our leadership position in really what is now an AI era for our human capital management industry.
Okay, so let's go over the Paycor acquisition, which I thought was a terrific idea, still do. Some analysts were talking about the moderating inside Paychex, the growth is moderating Paycor. I again couldn't see that, but maybe you can explain what they were seeing, or I just didn't get it.
Yeah, Jim, look, first I will say there's a lot of confusion with the analysts in trying to understand the numbers. Remember, when we purchased Paycor back in January, we announced, and in April, we fully integrated Paychex's enterprise business into the Paycor brand. And so we've commingled a lot of things. And so they're trying to do comparisons back and forth. That being said, we continue to make good progress on the Paycor integration. We remain on track to achieve the revenue synergy targets we set out for the fiscal year. We now expect $100 million in cost synergies for the fiscal year. We started with a commitment of 80. We've raised that both quarters. We're very happy with the activity we're seeing, the bookings we continue to see quarter over quarter in our enterprise marketplace. And so, again, we feel good about where we are. We understand there's some confusion in the numbers. And I think as all of this gets sorted out, I think what everyone's going to understand that Paychex and Paycor are better together, and that this has really expanded our runway. It expanded our market opportunity, $10 billion. And I think the cross-sell opportunity we have of our HR advisory solutions into Paycor's client base is just beginning, and we continue to build momentum.
Oh, at the same time, I also think that there's this perception that your businesses, small, medium-sized businesses, will be hurt employment growth by AI. It's actually the opposite from what I can tell. The businesses that are most insulated from that are small, medium-sized. The large ones, I don't know. If I were doing a large, I'd be worried that maybe there's some places where AI can replace workers. But at your level, workers can replace workers, not AI.
You're absolutely right, Jim. But I would even say I'm not sure I even buy into this concept that AI is going to lead to mass unemployment. The fact of the matter is tech does not destroy jobs. It evolves them. You go back and look at all the technological revolutions that we've had. We've continued to evolve. Now, I think it's true when you have disruptions. One of the things that we know happens, a Fed study would say, there's about 2 times increase in the number of new business starts. Guess who does most new business starts? Paychex. And we are less exposed from an AI risk perspective if this would happen. I don't think it will, but if it does, 70% of our clients are blue and gray collar workers. Think plumbers, electricians, restaurants. And 95% of our clients are in basically companies that are less than 100 employees. So we really feel that we don't think small businesses are going to be impacted as much, both because of our composition, but we don't necessarily buy into this AI is going to be a big job killer like many people believe.
Okay, so let's deal with reality. I think business seems to really be good. Small, medium-sized business seems to be strong in the country. That I still see businesses being created. It's not, of course, everyone would like the Fed to cut because there's some businesses that are really hurting. But you're not seeing any diminution in the starting of small businesses, are you?
No. Look, I think when you step back at a macro basis, our small business job index really has remained relatively stable in 2025. We also see continued moderation in wage inflation. What we reported today is our same store workforce levels for our clients. Now that's more broadly across our entire base, not just the small market, which is 50 employees and less. That's essentially flat for the quarter. What we see is continued challenges, particularly in the small end of the market, finding qualified employees. The other thing I will tell you, Jim, is, of course, there's businesses are trying to manage their costs. And that's one of the things we reported today as well. One of the things that we've seen thus far is that a lot of our clients are not buying as many of our ancillary attachment products as what we expected for the quarter, and that led to some of the guidance discussions that we had today. But overall, small businesses are healthy. I think the macro environment is solid. We see no signs of recession, and I think going into 2026 with some tax clarity, interest rates, as you mentioned, beginning to ease, I think we have some things to look forward to.
Yep. Is there anything in the big, beautiful bill that people would say, listen, I got to call Paychex, figure this out, how it's impacting me?
Oh, my goodness. So no tax on tips. That's going to be a good one for us. You're trying to figure that out and then trying to help every one of our clients' employees fill out the right forms so they can get credit. Now, we've got 1 year kind of grace period, but I think as we go into 26, that's going to be an option. opportunity for us.
And then I know you're involved with the Federal Reserve. Have you told them, look, there are possibilities of a slowdown? We've got to be aware of it?
I think what I've relayed to the Fed is what I've relayed to you, which is what we continue to see as moderation, that labor growth in small businesses is solid, but not as strong as it was last year. And the things that I continue to see is small businesses trying to manage their cost. And so I do think that the Fed, again, has taken actions to try to hedge their bets on the employment front. But at this time, Jim, we're not seeing any signs in our other data or indicators that would indicate some looming unemployment issue or some recession.
All right, that's very good. That's what I wanted to hear, because that keeps me from saying, listen, you got to sell a lot of stocks. If you were to tell me otherwise, then I'd have to rethink, because you have the best display of everything in front of you. I want to thank John Gibson, President and CEO of Paychex. John, thank you for coming on the show.
Thanks for having me, Jim. Happy holidays.
Oh, thank you. You too. Mad Money's back in for the break.
Coming up, you called in looking for answers on Kura Oncology. And after a night of studying, Cramer is ready to deliver his report on the biopharmaceutical company. Next.
All right, so last night we got this call from Harlan in Washington. I don't know if you remember it, but he wanted to know about a small-cap biopharma company. It's called Kura Oncology. He made a good pitch, pointing out that Kura just earned a $135 million milestone payment from its Japanese development partner, and that's Kura Oncology. Man, that's a pretty substantial cash injection, we thought. Maybe check into this thing. The key here is that this is a development stage biotech that's working on cancer treatments. Often those are indeed worth speculating on, as long as you realize that what you're doing is speculation, not investing. I mean, it's not like betting on Kalshi. It's a little more toward putting some money down, but it's certainly not something you expect 2 or 3 years to work. It may not. If Kura makes a big breakthrough, you're going to see huge gains. If it doesn't, or if there's setbacks, it will be eviscerated, and you'll see what I mean about it being a spec. And that's why I thought it was worth doing some more homework and circling back from good old-fashioned Speculation Friday. So let's go to the backstory. Kura Oncology was founded by 2 organic chemistry PhDs a little over a decade ago. They sold their previous company, Intellikine, to Takeda Pharmaceutical for $190 million up front and $120 million in potential milestone payments way back in 2011, meaning if they hit certain things. That's a legitimate track record to me. Eventually, they founded Kura and licensed a promising early-stage cancer treatment from Janssen Pharmaceuticals. Now, these guys thought the drug could achieve greater results if they could more precisely identify patients who might benefit from it. And that philosophy of precision medicine, very big right now, has been at the core of the Kura story since then. Today, Kura Oncology is a larger, mostly clinical-stage biopharmaceutical company that's working on a number of targeted cancer treatments. The company's primary product candidates fall into 2 buckets. The first is called menin, M-E-N-I-N, inhibitors, which work by getting cancer cells to prevent the expansion of cancer cells. Their lead drug is a menin inhibitor that's aimed at stopping the spread of leukemia. The other bucket is what's known as FTIs. These drugs focus on a specific enzyme that helps cancer cells resist all sorts of targeted treatments. Kura wants to inhibit that enzyme, making it easier to for other cancer drugs to do their job. See, it's done as a combination. That's what's going on here. Now, if you look at the stock performance since it came public in 2015, okay, not much of a winner. Kura came public at $8 a little over 10 years ago. Today, the stock sits at just under 10. Not unusual for a lot of these biotechs. This one caught fire during the COVID era of speculative mania, peaking at $43 December 2020, but it came right back down the next year. More recently, Kura roared in late 2023 and early 2024 thanks to some positive data from an early-stage clinical trial studying their company's lead drug as part of a combination therapy with another drug for acute myeloid leukemia. But in late November of last year, Kura announced a collaboration with Kyowa Kirin, that Japanese drug we mentioned earlier, and the stock got poleaxed in response. Why? Because many investors were hoping the company would be acquired. The collaboration with the Japanese effectively took that off the table. Earlier this year, investors were still pretty down on Kura, with its stock sinking to its lowest level since 2016. In February, the company announced some phase 2 data on its lead leukemia drug, but there's also pretty controversial. Some liked them, some hated them. One analyst even downgraded the stock, citing a lack of clarity and a lack of differentiation from its competitors.
Sell.
whether we're talking about efficacy or the drug safety profile. In retrospect, the bulls were right. Kura submitted the drug for FDA approval in April, and we got more positive data on this one throughout the year before the FDA approved this drug, and it's now known as Komzifti. Earlier this month, the first commercial sale was made, triggering the latest milestone payment, and that's why Kura stock has roughly doubled from its springtime lows. At the same time, we've seen more positive clinical trial results from this drug across various different types of acute myeloid leukemia. Plus, there were a lot of very positive conversations about Kura coming out at the annual American Society of Hematology conference that occurred earlier this month. Analysts at Cantor Fitzgerald had dinner with Kura management at the conference, and while most of the conversation was about the commercial prospects for Komzifti, there was also lots of talk about how this whole class of drugs could be used to treat acute myeloid leukemia, especially in combination with other treatments. Right now, this drug is approved for one type of disease. That's a $350 to $500 million end market. But if it gets approved for every type of acute leukemia, well, then you know what? That's a $5 to $10 billion market. Separately, analysts and citizens pounded the table on Kura because they really believe in the technology, and the company's now sitting on a big pile of cash. This is a company with a pro forma cash position for $745 million, very little debt. When you consider that its market capitalization is just $500 million, oh, come on, you're practically getting their whole cancer franchise for free. And you know what? I agree with the bullish analysts. Of course, I stand by what I said to Harlan last night. It's purely speculative stock. But if you want to speculate on cancer treatments, I think this could be a great way to go. Overall, I see lots to like here. And by the way, everything I've mentioned so far only relates to Kura's first class of drugs, the menin inhibitors. I haven't even considered anything from their other big category, the FTIs, because those are earlier stage. I also like that Kura now has plenty of cash flowing into the business, and I love the fact that the stock has pulled back hard over the past 2 weeks, despite all the good news coming out of the American Society of Hematology conference. This stock peaked at $12.49 mid-November, the day the FDA approved the lead drug. It's now down to just under $10, back to where it was trading in mid-October. In other words, you're actually getting that FDA approval for free at this point. So here's the bottom line. Harlan in Washington brought us a good story with Kura Oncology, and we were right to look into it. While it's very much your typical speculative biotech story, it's one of the stronger ones I've seen in a very long time. So what I say is, thank you, Harlan. Now we're going to go to Lee in New York. Lee.
Hey, Jim. I've been a member of your investing club for a long time. You've made me a lot of money. I always use you as the last resort before I pull the trigger on buying a stock.
I like that.
I had to reduce some of my gains, and what I did was I did it through my IRA, so I didn't have to pay taxes. And I was looking at United Healthcare, UNC.
Okay, that's a down and outer.
With what was going on.
I'm not worried anymore. I think that they can handle pretty much anything that's thrown at them. What I do worry about, just so you know, is that that's not a great part of business right now. Because the president, I don't know if you ever, when you hear him, oh my God, does he hate these companies? And if I were in the business, I would say, wow, the president's coming after me. But it's out of favor, and it's a great company, and it will come back. I salute you for the patience that is needed. That one could be a good one. How about we go to Colby in North Carolina? Colby.
Jim, what's up? Booyah.
Booyah, Colby. What's going on with you?
What's up? I'm doing good. Just wanted to shoot you a call. I've got a value stock for you. So I want to hear your thoughts on Align Technology. You know, they've got
Joe Hogan.
Leadership with Invisalign, but that the competition in the industry is increasing. Do you think?
Yeah, well, that's the problem. I loved this company when it was the only game in town. But the fact that there are others makes me very, very circumspect about it. I'm going to have to say, take a pass on what was once a company that really had a feel to itself, but no more. Anyway, I want to thank everybody for our guests, our callers, for bringing attention to things like Kura Oncology. It's very much your typical speculative biotech play, but I would never have known about it if it weren't for Harlan. I think it's one of the stronger ones I've seen in years. Much more made money, including an exciting round of MI Diversified. That's where you tell me your top 5 holdings. I tell you if you're diversified enough, maybe just switch it up. And in a lot of cases, there aren't too many tech stocks in people's portfolios. We're going to look at that. Then I see not one, but 2 superstar CEOs at 2 different companies deserve your attention. I'll reveal the names, and I got to tell you something. They're going to surprise you after today. Of course, all your calls rapid fire in tonight's edition of the Lightning Round, so stay with Cramer. We've had a roller coaster of a week, haven't we, with the market being swayed up and down by the outsized influence of tech and AI stocks. And if you don't have a diversified portfolio, I mean, you could end up being crushed weeks like this. And that's why tonight we're playing a very important round of Am I Diversified? This is where you call me. You tell me your top 5 holdings, kind of like in the book, right? You know, in How to Make Money in Any Market, where I say pick 5. I tell you if your portfolio is diversified enough or if you need to mix it up a little. Let's start with Lewis in Massachusetts. Lewis, you're up first. What have you got for me?
Hi, Jim. Happy holidays. Booyah to ya.
Booyah, right back at you.
As I pivot from the year of magical investing to a year of practical investing, will 2026 be another great year? My 5 stocks are JP Morgan, Google, Boeing, Procter & Gamble, and Broadcom. Tell me, Jim, am I diversified?
Let's go to work in a year of practical investing. It's upcoming. I may have to steal that from you. I'm sorry. It's too good. I'll credit you periodically. Okay, so Broadcom, we know, is that great semiconductor, fabulous semiconductor company that's just riddled through the data center. I love it. Big position. Boeing is probably right now my favorite stock for the next 3 months. It's doing great. Procter's the other one. We have a new CEO coming in, obviously personal care products. And then we're going to see how this does. And that be I'd say maybe the best second half stock for next year. JP Morgan is, to me, my number 2 bank after Wells Fargo. They hate to hear that. They get very upset. And then Alphabet is, you could say, well, is that too close to Broadcom? No. Alphabet's also Waymo. Alphabet is also YouTube. It's way bigger than Gemini. And although I love Gemini, I was on it like 100 times today. So we have diversified tech. We got semiconductor. We have aerospace. We have consumer product. And we have banking. I got to tell you, I think that's perfect. Lewis's portfolio is just nothing short of perfect, and I thank you. Now we're going to go to Tony, all the way down in Florida. Tony.
Hey, Jim, I want to wish you and your family and everybody that works for you and Mad Money a happy holiday season and be a safe one.
Right back at you. Thank you.
And my 5 stocks is Amazon, Costco, Eaton, Palo Alto, and Home Depot. Am I diversified, Jim?
Good. This is like our previous caller. A lot of these people are club members. These are very many of our club member stocks. All right, Home Depot, well, that's a play on housing. I'm not calling it a retailer. I'm calling it a play on housing. Palo Alto is, really cybersecurity, okay, and growing. Did a big deal with Google today. Eaton is primarily not data centers, primarily electrical equipment. It does have a huge data center business. We're going to call it electrical equipment. Amazon is obviously Amazon Web Services and retail. And then Costco is a retailer whom I think is actually a little more troubled. We've had to sell a lot of our Costco for my charitable trust because we did not like the way the conference call went when they reported last. But retail, but remember I told you this is housing. Palo Alto, cybersecurity. Eaton is electricity, producing it, keeping it good, and making so that the data centers hooked into the grid. And then Amazon, obviously, is one of the great tech companies, but is really also a retailer. I think Tony's fine. Now, some would say, wait a second. You got 3 retailers here. I remember I'm thinking Home Depot is a housing play, Costco is a club company, and Amazon is a tech company. So we're okay. Now we're going to go to Michael in Arizona. Michael.
Booyah, Jim. Happy and
Booyah.
healthy New Year.
Oh, thank you. Same.
My top 5 stocks of the 27 I own are NVIDIA, CrowdStrike, Apple, Goldman Sachs, and Robinhood. Am I diversified?
Wow. Interesting. We'll do some time on this. Our CrowdStrike, we know, data along with Palo Alto, amazing cybersecurity company. NVIDIA, that's the largest semiconductor company in the world. Apple is a consumer product company that's tech. Goldman Sachs is a boutique, but not so boutique anymore, bank. In other words, they're not as big as Bank of America, not as big as JP Morgan, but they have an amazing brokerage business, and they're terrific in their investment house. And then Robinhood, which does nothing like Goldman. People may say, well, wait a second, 2 brokers. This is for retail. Goldman is for the ultra-rich and for company. So they're very different, and I don't want anyone to confuse them. Now, Apple and NVIDIA are both pure tech. I own Apple, and I say own it, don't trade it. And I say NVIDIA, own it, don't trade it. So I'm in a jam here myself. I am undiversified because I own both of these, but I understand exactly why Michael could feel I should be in it. A real classic person would say Robinhood and Goldman get rid of one. NVIDIA, this is tic-tac-toe. NVIDIA, Apple, and CrowdStrike get rid of two because there are three tech and two fin. But I showed you how I divide them so you understand why if you were doing this, say, for how to make money in any market, my 5-stock program, it would work for you. And that's why I am teaching this way, because of the way we do it and how to make money in any market. And I think you'll understand it and like the book and understand what we're trying to accomplish here. Rick in Illinois. Rick.
Jim Cramer, it's so nice to talk to you. I hope you had a good day.
Right back. Yeah, a dynamite day. I don't know. Like a lot of the guys were looking at different catalogs. I was busy working. Just kidding. Just kidding. I was looking at catalogs. No, I haven't looked at a catalog since Sears was in business. What's going on?
I want to tell you about 5 stocks I own.
Okay.
Eli Lilly, SL Green, Mr. Softy, Chevron, and Taiwan Semi. Am I diversified?
Really interesting setup here. Okay. So Taiwan Semi is the actual fab that makes the chips for Broadcom, makes chips for AMD, makes chips for, yes, NVIDIA, all right? That's in Taiwan, very important. Eli Lilly is the company that has GLP-1, Mounjaro, very powerful drug. They're going to have a pill form next year. That's going to revolutionize everything. I think the stock's going to go up another $500 billion. I kid you not. Chevron is my favorite large oil company with a good yield. That's run by Mike Wirth. SL Green is a company that's come back from the dead, basically, and it's a REIT in New York. I don't really want to REIT in Europe, but that's what they do. And then Microsoft, okay, Mr. Softy, we know it's business-to-business software with the consumer side of it, too. So I'm going to say this is semi, this is software, this is drug, this is oil, and this is retail, and I'm going to bless all of them. Now, would I keep SL Green? I do happen to see Federal Realty coming back, and I like to see Don Wood in that portfolio instead of SL Green. Now, everybody understands what we're doing here. This is right out of my program of how to make money in any market, which you must understand in order to be able to profit from individual stocks. Thanks for playing. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. So on the lightning round from Ralph Gross, I'm Sam Stock, about buy, sell, the stock price, and then the lightning round is over. Are you ready? Ski that on the lightning round. Let's go to Daniel in New York. Daniel.
Yes, hi, Jim. I just want to know, what are your thoughts on One Oak? Ticker symbol
One Oak is a buy right here, and not just because I think Walter Hulse is terrific. Let's go to Jalen in Texas. Jalen.
Hey, Jim. Such a pleasure to speak to you. My question is on Lucid stock.
Well, I'll give you my answer, which is now we're going to Alex in New Jersey. Alex.
Hey, Jim. Alex from New Jersey. Happy holidays.
All right back at you. What's going on?
Hey, I wanted to give you something different. I know you get asked about a lot of the same stuff. Give me what you think about ticker SATS.
Oh, man, they've got a lot of money. They've sold a lot of patents. I mean, they've sold a lot of product. It's all about it's all about their, I'm going to put this, their bandwidth, their broadband, and they've got it, and they've sold it, and I think the play is over. Boy, they had a lot of it, more than I realized. Let's go to Tammy in Nevada. Tammy.
Hey, Jim. Hey, we're proud members of your investing club, and I just bought your book for my husband for Christmas.
Thank you very much. That's a very good, easy gift to get. You can still get it on Amazon. How can I help?
Exactly. Hey, with that recent sour news on StubHub stock, how do you think they can address their ticket?
No, they're losing too much money. We're going to stay away from them. We don't want to own the ones that are losing money. We got so many that are making money that are going down. We need the losers. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, great leaders abound in the business world, but Cramer has found two who aren't getting the credit they deserve. He's breaking down why you can trust the CEOs of FedEx and Nike. Next.
racetrack, you learn to bet the horse, not the jockey. No jockey can turn a lousy horse into a winner. You don't go from being destined for dead last to win, place, or show, no matter what the jockey does. That's not always the case in business. While a solid company can be led by a mediocre leader and still prosper, sometimes you can get a situation where the CEO can turn things around, triumph, even transform an underperforming business into a superstar. Right now, I see two of these CEOs orchestrating turnarounds happening right under our noses in the leadership of Raj Subramanian at FedEx and Elliott Hill at Nike, but only one of which is being recognized. FedEx, which was built by the late Fred Smith, is a remarkable company that's become ubiquitous with one of the greatest competitive moats I've ever seen. Only United Parcel can rival him, and I think FedEx is a better company. I'm very proud to be able to call Fred a friend, and I cannot believe he is no longer with us. He was a leader like no other. That makes his shoes very big to fill, but Fred told me that I'd be dazzled by his successor, Raj. Well, of course, Fred was right about that, just like he was right about so many other things. Thank you, Fred. This latest quarter showed a FedEx that's better leader than I ever thought possible, with incredible numbers, albeit unheralded, move to the business-to-business space, pivoting some from its previous business-to-consumer orientation. Business-to-business is sticky. It is where the money is. FedEx pretty much owns the pharma delivery business now, the biggest segment of delivery in the country. They've also developed a data center business that could eventually be huge. It's really happening their way. Best of all, this happened at a time when you might have expected FedEx to report a series of missed numbers, thanks to the tariffs. Think about it. China had been big. Now it's de minimis. Tariffs have roiled almost all cross-border trade. We have a slowdown in the U.S. and need the Fed's help. All these things would have probably derailed the old FedEx. Not so Raj's. Yet the stock barely reacted to last night's quarter. It's had a big run. My advice, stay long, comes down by more. How about Elliott Hill at Nike? This situation is much more complicated. Elliott and Herder have broken Nike, a company that literally seemed to have lost every bit of its former mojo. I use that comical word because it isn't comical in the world of sport. It's damning if you don't have it. Nike lost it. Under Elliott's predecessor, the company became a dull, non-inventive, mediocre sneaker play, with its product being pushed through the digital channel, even though most people like to try on a pair of expensive shoes. Elliott had to dismantle North America, which had been divided into men's, women's, and children's shoes, returning the business to sports verticals like running, basketball, international football. He had to clean up hundreds of millions of dollars in old, not that attractive inventory. He had to patch up destroyed relations with retailers. And he pulled it off in a little more than a year's time. It was incredible. The Nike U.S. business had some killer numbers in the quarter announced last night. The turn's at hand. So why did the stock get annihilated then, down more than 10%? Because the previous regime didn't just screw up the U.S. It put China on a course of destruction that's come home to roost right on Elliott's head. The China portion of the conference call had me chugging Pepto-Bismol. Nike lost China quicker than you could say John Patton Davies or John Stewart Service. And yes, it was that bad. Go read the conference call. When you do, you hear this line, quote, "We always believe that our growth will come through sport. But the reality is we've become a lifestyle brand competing on price in China." End quote. Lifestyle brand? Nike? Competing on price? That's for mortals. Nike's immortal. Numbers were horrendous. A worse record than the Vegas Raiders or even the Titans. Remember the Titans? This is awful. It's simply too hard to turn things around in 1 or 2 quarters, even though Nike's U.S. business has already found its footing. Elliott's now setting his sights on China. You either believe he can win, or if you don't, you have to sell. I don't know when this stock will make a comeback, but I bet it happens in the next year. And when it does, the $58 stock was headed to $80. However, if you're not a believer in Elliott, then just sit this % out, because I've got a feeling you won't have the patience to wait for the turn. I like to say there's always bull market somewhere. I promise to find it just for you right here, Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.